Good morning, everyone. Thanks for joining us today. Welcome to the Centrepoint Alliance half-year results investor conference call. All attendees now are in listen-only mode. On the call today, we've got Centrepoint Alliance CEO John Shuttleworth and CFO Brendan Glass. I'll pass you across in a moment to John to kick off our discussion of the company's half-year results. We'll have a presentation today followed by an opportunity for Q&A. If you'd like to ask a question on the call, please type it into the Q&A panel in your Zoom app. So to kick things off now, I'll hand across to Centrepoint Alliance CEO John Shuttleworth. Go ahead, John.
Yeah, thanks, Tim, and thanks everyone for dialing into our first half results. I know it's a busy time of the year and many of you are dialing into other earnings calls. What we'll try to do is give you a really good flavour for how the business is performing. I think just over 15 minutes we should be able to cover most of the key areas. The approach that we want to take today, I'm going to go through some of the business results and the strategy, but the lens I want to put on it is as we're taking you through the results, it's we hit the anniversary date of the Clearview Advice acquisition in November last year. So we're sitting here 14 months after operating the business. So we'll give you an update on how the half has performed, but we really want to also demonstrate fundamentally how this business has changed and how it's a much stronger business. So with that, I'll just take you through some of the business results. So the key messages really coming out of this is that, 14 months post the Clearview Advice acquisition, we have a much stronger business and feel that we're very well positioned for future growth. We've got a management team that have demonstrated their ability to integrate M&A and drive out and extract synergies. We've had a really disciplined approach to capital management and the successful sale of non-core assets. We have been paying consistent dividends and we've had good shareholder alignment whilst increasing our balance sheet strength. One of the things we're very focused on is commercialising strategic initiatives and revenue adjacencies. When I use that word revenue adjacencies, I'm referring to other services we can distribute to our advisors, services that they need to procure. So we're spending a lot of time on those. Some things I can talk about, other things as we're bringing closer to launching those in the market, I'll be able to provide you with some more information. And we're obviously very well positioned to capitalise on M&A opportunities in this current environment. A quick snapshot of the results, and Brendan will take you through some more detail, but gross revenue 134.3 up 38.8 million or 41%. EBITDA, and this is normalised, excludes the sale of the Ventura Funds business, was 3.8 million up 1.3 million or 52%. Gross profit of 16.4 up 2.3 or 16%. The profit before tax of 3.7 million included proceeds from the sale of Ventura. That was up 2.8% or 300%. Some of that was organic and obviously some of that attributable to the profit. We had just over $15 million in cash in the bank, up slightly on the June period. And in terms of dividends, there's a 0.5 cent ordinary dividend, and we're also distributing some of the proceeds of the sale of the Ventura Funds with another 0.5 cent special dividend, taking the total to 1 cent. When you think about our business over the last 14 months, we acquire a business, and the most important thing is that you can really end up emerging with a well-managed business. So our focus over the last 14 months has really been how do we make sure we embed a consistent operating model with standard kind of business processes and standardisation amongst the teams. We've brought together two different pricing models with Clearview and the Centrepoint Alliance or Alliance Wealth and PIS pricing, where we now have uniform pricing. Pleasingly, we've seen very strong service level improvement back to pre-acquisition levels, which is a really important thing to us. We are a service company. We've seen increasing advisor satisfaction. We run a Net Promoter Score survey. We've introduced that. We go through that in detail, and we're plus 24, which was up from plus 13 the last survey. In the numbers, we've had good advisor retention in a year that Facia has seen some advisors exit the business, and just a real disciplined approach to margin expense management. We've called out here just a few metrics. In the next slide, I've got a bit more detail, but you can see our gross profit, the three columns, and the intention of showing these three is the first column is pre-acquisition. and it just sets a bit of a baseline. The middle column shows the first half FY22, which was really a transitional period. There was a couple of months of Clearview data, but then you can see the first half where the data's now normalised as we're running the business. So gross profit of 16.4, pleasingly EBITDA of 3.8. And when you look at the overhead number, I think one of the highlights in the results are that we have absorbed and extracted synergies. So we've managed to contain our overheads kind of effectively as we've worked through the business. There's a bit more data. I won't go through every single metric here, but there's a few call-outs. The EBITDA margin, you can see, has increased. Pleasingly, the recurring revenue percentage, 95%, is very pleasing. At the bottom of that revenue profile line, virtual services. What virtual services are, we have licensee fees that we derive, but we sell other services to the advisor network. And this is the power of the network. Many advisors need, power planning and virtual assistant support and some of the self-licensed other compliance services. So we're really focused on building up that revenue stream. And the cost to income ratio has come down, obviously, as we've got more scale and managed the overhead. So overall, I think when you look at the pre-acquisition, the period of integration where we've emerged, we certainly feel very positive about being in a strong position. I wanted to share this slide, and it shows the top 10 licensees, and it includes advisors under the existing license. So it excludes self-licensed. So if you take our business, for example, we've got just under about 800 or 770 odd self-licensed advisors. So it excludes that. It's just advisors operating under our license. But what we've done is we've taken a 2-year snapshot to say, well, what's actually happened? So you can see the number of authorised reps in the first column, and Centrepoint is ranked number 3. You can see what have been the appointments of new advisors under that licence, what have been the resignations, and what have been the net change. And as you run through the numbers, you can see that having absorbed an acquisition to be in the strong position that we're in, and having retained advisors despite FACER and everything that has gone on, we're in a very strong position relative to our peers, and it's something we're incredibly proud about, thankful for the network for their support and loyalty to the group. Our strategy, and this is a slide I've shared previously, and I'll just go through it, and nothing has changed with our focus. It's all about execution, implementation. So the first objective is we still want to grow the number of licensed advisors, and we continue to look at organic growth. We've got a very strong pipeline, and we hope to see some further appointments over the next 6 months, because there's some new advisors well advanced in the pipeline, but again, making sure we have quality firms only. Self-licensed is a really important strategic area for us. We have a strong footprint with 194 self-licensed firms, and within those firms, there's around 770 advisors. We're expanding the depths of services, digitising the service provision. So you can expect to see a whole relaunch of that particular area coming up, and hopefully that's something we can talk about at the full year update. The salary channel is important and remains profitable. For us, it's really about, can we find a corporatised firm that we can absorb? And we're also doing a lot of work, which also has reciprocal benefits for our advisors, in investing in some of the digital advice technology to improve the efficiency of the advice process. I've got a slide coming up in a minute on the lending solution. So as you know, we're trying to grow the aggregation business, but we've also launched last year lending as a service. So I'll give you a bit of an update on that, but that's starting to spin and get momentum. And then the whole asset management, whilst we sold the venture funds business, the focus is very much around launching SMAs. We'll also be looking at MDAs in the market and really expanding our investment management business. We're well advanced with discussions to get distribution with some of our partner platforms of those managed accounts. And then really, I won't go through it, but we've got really strong foundations to support that. A quick update on the lending as a service. So just to remind everyone on the call, our core business was we're a boutique aggregator, and we have all the infrastructure. So we have credit license, loan application, platforms, lending panels. We have all the infrastructure, 80 brokers, $3 billion loan book. In September, we launched lending as a service, and what we're doing is we're enabling advisors to build a lending business, and they can operate as authorised reps under our credit licence. Obviously, it was launched in the back half of the year. We had some initial firms coming on, and we're now seeing better momentum, and we're really picking up. We've got 17 firms that have signed up and participating, and a big pipeline of future firms. 17 out of 535. We believe we can really penetrate that base. We've settled around 35 loans. That's a total of settlement and pending settlements, and we have a strong pipeline. Really pleasing when you launch a new product is the strong feedback we're getting from those early adopters of the service. And there's a couple of quotes there about just wouldn't hesitate to recommend, and at a time when interest rates are going up, providing lending services and helping advisors, clients refinance is certainly something they're very, very focused on. So that's a quick snapshot of the business. I'll come back with after Brendan's done the financials, with an outlook, but I'll just pass on to Brendan now to take you through a bit more detail on the financials.
Thank you, John. Looking at the financial results summary and the key themes that underpin those, our gross revenue of $134.3 million was principally driven by the Clearview Advice acquisition, as well as organic advisor fee growth. Our gross profit had similar themes in terms of that 16% uplift, as well as some offsetting investment margin runoff. Our management expenses are up 9% on PCP, which is due to principally $800,000 increase in employment as a result of the acquisition. The cost to income ratio has improved to 77% on the back of that gross profit increase and the carried over synergies, which we realised in the second half of last year. Our EBITDA of $3.8 million is up 52%, excluding LTI, the one-off transaction costs from Clearview and the asset sale of Ventura. And that's mainly driven by the Clearview Advice gross profit increase and that organic licence fee growth I mentioned. Profit before tax of $3.7 million is up 2.8 on PCP, of which $1.5 million was a one-off from the asset sales. Now, looking at the revenue and expense analysis in a little bit more detail, on the revenue side, advisor fees have grown by $500,000 for the period. That's on the back of more recently acquired advisors being transitioned to a full rate card. We've had a reduction in investment margin revenue of $1.3 million, which is attributed to $750,000 in CFS platform rebates, which ceased in June 2022. There's $200,000 in Ventura sales, which are no longer attributed on the back of the sale of the business, as well as $200,000 in lower VMAPS margin. Our Clearview Advice acquisition revenue has increased by $3.5 million. Now, we had 6 months of combined earnings for this half, as opposed to 2 months for the half in FY22, the first half of FY22. From an expense perspective, the expenses were up $1 million or 9%. They were driven by employment costs of $800,000 or 10% increase due to circa 7 FTE for the period. Now, notably, the Clearview Advice revenue contribution for the period was $5.2 million, so that clearly demonstrates the scale derived from the acquisition. Subscriptions were up $200,000 from the acquisition on the back of advisors increasing to over 500 advisors. The professional fees were down $100,000 due to the cessation of expenses from the Ventura sale. And our travel, marketing and other costs were up 5% due to the resumption of spending once the COVID pandemic restrictions were lifted. Looking at the balance sheet, as at 31 December 22, our cash of $15.4 million was up $700 on June 22. That's due to $2.9 million in net cash from operations and somewhat offset by the $2 million in dividends paid in the half. Our claims provision at the end of December, we had 16 open claims in comparison to 11 open claims at the end of June 22. So still a very manageable and acceptable number of open claims. Our net assets increased primarily due to $3 million in net profit after tax for the first half, offset by somewhat by $2 million of dividends paid. Now, looking at the cash movement for the half in a bit more detail, the growth of 700,000 for the period was principally driven by 3.8 million in gross cash from operations. We had 400,000 in final one-off transaction costs for the Clearview acquisition. We reduced accounts payable by $2 million for the period, which is principally advisor payments, which is a timing matter. We derived 1.5 million, as we've mentioned, from the Ventura asset sale, and there was an outgoing of 2 million for the dividends paid. And then we had $500,000 in outgoings for other items, which that's largely made up of rents and rent/lease payments of 300,000. Looking at the balance sheet snapshot and the trajectory of the business in the last 2 years, you can see the robust balance of 15.4 million without debt. Our net tangible assets have replenished to $9 million on the back of improved operating profit, loan redemptions from the NEOS loan, which was repaid in last financial year, the non-core asset sale, Ventura, and that's enabled $8.8 million of fully franked dividends to be returned to shareholders in the last 2 years. We still have $12.5 million in franking credits available. And in the last 2 reporting periods with the combined business, we've delivered dividend yields of circa 6%. You can also see earnings per share growth. And in the reported period for this first half, we've seen double-digit return on equity. So we're the business at the moment where we've got gross revenue running at 134 million for the half and circa 270 million annualised. The ECL to gross revenue ratio is just 0.01%. So that reflects the nominal credit risk in the business and the fact that we receive our cash upfront for earnings. The claims payments have pleasingly continued to reduce. So for the first half of FY21, we paid out in claims 900,000, and in the first half of this financial year, we paid just $100,000, which is a new low. So over to you, John.
Thanks, Brendan, for that update. The final slide I wanted to just give everyone is a bit of a sense of what are we seeing, how does it feel? So firstly, we are feeling incredibly positive about where the business is at. We've got strong financial performance, having got through integration, got the uniform operating model, and what we've tried to demonstrate in this brief call, show the benefits of scale coming through. We've got a really good foundation. Our sales pipeline is strong, and the conversion of that should see some really good growth in or organic growth in advisors. The strategic initiatives, and look, we have a range of initiatives. The approach we take is when something is about to launch, we can talk about it, but we don't want to preempt too much stuff. But there's quite a few things that will come down the pipeline, and we're hoping to be able to update either just prior to or during the full year investor call. But we're getting good progress in building scale on or momentum with lending as a service, and the managed accounts and the building out of that investment management business is incredibly important. If you talk to advisors in our network, nearly all of them are experiencing incredibly strong demand. They're looking to grow their business. Several of the firms have been appointing new authorised reps within their practice, and it feels like our advisors are in a good place, and with just the demand that they've got. The best guidance we can give at this point in time is that our second half for FY23 will be in line with the half we've just delivered, excluding any one-offs. So that's really a snapshot. So that basically concludes the presentation. I'm going to hand back to Tim now, and just see whether or not there's any questions from those who have dialed in.
Thanks, John. Thanks, Brendan. We have had a few questions come in from investors on the call, and just a reminder to everyone dialed in, please do put your questions into the Q&A panel and we'll address them that way. So first question that's come in, congrats on the excellent results. Could you please describe the revenue model for the lending as a service business?
Effectively, how lending as a service works is that when an institution someone takes out a loan, the lending institution typically will pay 60 basis points on origination of the loan and a 15 basis point trail. What we have is we have salaried brokers in-house, and effectively what we do is we retain a portion of that revenue, and under the legal structure and the arrangements of being authorised reps, the advisor can also be remunerated. So I won't go through the exact percentages, but effectively it is a share of the revenue on origination and trail of the loan.
Very good. And still on lending as a service, another investor's asked, can you discuss the technology stack in any further detail that sort of underpins what you're delivering there?
Yeah, well, look, we have a cloud-based lending system. Rather than go through the sort of details, effectively what it does is it enables the brokers and advisors to log in. It's sort of a combined CRM lending system. You can basically put in a customer's details around what type of loan do they want. Is it a principal and interest? Is it interest only? Do they have preferred lending institutions? They fill out some of the basic criteria. And then what we have is we have a database with many hundreds of loans across 60 lenders. It will then automatically populate or present the best lending opportunities. The broker then has a discussion with the advisor who is working with the client on the loan options and whether there's a better deal than the one they have in the market. And then the broker then deals with the lending institution. So it really is think of it as a cloud-based loan CRM, loan origination and CRM platform that we use, which automates the kind of process. So that's effectively the kind of underlying infrastructure that we have in the business. Yeah.
Cool. Sounds good. Thanks, John. Looking to the licensee business, what levers do you have at your disposal to increase the satisfaction of advisors?
Sorry, I missed the first part of that, Tim.
So the question is, how do you increase advisor satisfaction?
Look, the first thing is what we do is we're a service company, and advisors come to us for a whole range of services. On a technical sense, they need a license to operate on. But, we provide technology services, we provide training and education, we have an advice technical line. And really, when you're a service company, you have to provide quality services in a timely manner. Every single query is tracked on Salesforce. We go through each of those, we look very carefully at the response rates and the quality, and we track it and we get feedback. So on the one dimension, we're looking at how timely are we responding to queries, not just on averages, but we spend a lot of time looking at the tails. So, what's the bottom 10%? How have we responded to them? What we're now supplementing that with is these net promoter surveys, which, in previous institutions I've seen really transform. We make sure that everyone in the business understands how we're performing. If an advisor is say a detractor and scored us less than 6, we look at not just the good scores, but pay a lot of attention to areas of improvement. Any advisor that scores us less than 6, we get in touch with. I would personally call them or the other executives, and we work through it. And what we're really finding is that when you're a service company, you try to have consistent standards. When there's dissatisfaction, it's usually there's been some departure from the benchmarks that we would set ourselves, and we just go through and try to establish why that's the case. So it's really a concerted effort that we go through to, at the end of the day, if you're a service company, you've got to communicate regularly. You've got to listen. A lot of our relationship managers speak to advisors all the time, so we know from talking to them who thinks we're doing a good job and we're not. And if we need to evolve and change our service model, we do. So I'll cut it off there rather than wrap it on too long, but it's really instilling a whole service ethic into the business and making sure that people understand that our advisors have the ability to choose, and as long as they get great service, then they'll stay with us and recommend other people to join us.
Yep, excellent. Thanks, John. Just looking at the sources of growth, the questions come in of the reported advisor growth. Can you talk to how much of that comes from the Clearview Advice acquisition? And more broadly than that, can you talk to the retention of Clearview advisors?
Yeah, do you want to touch the revenue split, and then
I mean, look,
do we know that?
The advisors acquired 14 months ago was circa 160 from Clearview. So, that's I guess simplistically 160 over 500 is the weighting between Clearview and Centrepoint Alliance incumbent advisors. And then we have had some attrition from that advisor number, and it's probably systemic of the FASIA guidelines and what's happened within the industry, to John's slide earlier in the presentation around attrition of advisors through education standards. So we have lost, I don't have the number to hand in terms of the exact rate, but it's, I guess what is evident from what I said before around the contribution of revenue for the first half, it's certainly within expectations of what we purchased. So that's probably the easiest way to answer.
Yeah. So look, I'll give you a sense of we've obviously had new advisors join and others leave since the merger. If I just looked at the terminations, I think there's been, the data that I had was there was around 38 advisors that had left. But none of them have, the reasons for leaving is, 10 retired, left the industry, 11 were a face-year exit, 4 sold the business, 6 moved to their own AFSL. We had 5 that went to a mid-tier competitor and 2 to a small AFSL. So what you're actually seeing is that if people are leaving, it's the standard dynamics in the industry. It's not anything fundamental. In fact, very rarely do we get advisors that are leaving because they're dissatisfied with the service, and we occasionally get that happening, but we try not to. But it's much more through just some of the restructuring of the industry, as I sort of outlined there. So that's the number since the merger that I just happen to have an email that someone sent me yesterday because we're talking about it.
Yeah, no, that's a great result, I think. And speaking of the those industry dynamics, John, another question that's come in, which is maybe somewhat tangential to what we've been speaking about, but it's probably worth addressing. An investor's asking if robo advice is a threat or an opportunity for a business like Centrepoint Alliance.
Yeah, look, there's been I see these things as if you break down and say what is robo advice, you're basically trying to augment the advice process using technology, and at the highest level, that's a great initiative and something that we would absolutely support. There's a lot of different models of robo advice, and some I would question whether they should be called robo advice, and there's some that are asset management players where they have a website and a risk-based questionnaire, and they say, look, fill out this risk profile and we'll recommend an ETF diversified portfolio for you to invest in. And samples in the US of the Wealthfronts, Betterments, and those sort of companies are there. And there's a few kind of local players in this market. The area that I think is the most interesting is that the advice process requires a lot of manual effort, getting statements of advice done, engaging with the client. So things like digital fact finds, things like automating paraplanning and driving the efficiency of the advice. And there's some very interesting startups. The efficiency across the industry is something that I think the whole industry needs to look at. You have many people will use things like Xplan, Advisor Logic, and Teleflow, and then they have to rekey all the data into the platforms after they've done the advice, and it's quite kludgy. So what I would say is digitising and automating parts of the advice process is an incredible priority for us, because it just means that advisors can service more clients, and we spend a lot of time. We've got a head of technology, and one of their core roles working with our head of licensee services is to say, are there better processes and ways that we can enhance that advice process? So I see it as completely positive, even if there's clients that are lower balance clients that an advisor, given they've got limited capacity, can't service, then I see the opportunity to leverage that. And, we used to use terminology about, an advisor sold, investor maintained concept where we can help people work out what products that they could go into. So the answer is a resounding. I think it's a great thing for the industry, but still embryonic in its development.
Excellent. Thanks, John. Good appraisal of what's going on there. Final question that's come through just for the time being is a balance sheet one. The question is, does the provision for claims on the balance sheet relate to historic claims alone?
No is the answer to that. So the historic claims that we had 30 claims in June 2020 when at the AFCA window was extended for 12 months. So all those claims have now been settled. So all those claims on the balance sheet now are claims that have transpired in the last 2 years.
Cool. Okay. Thanks, Brendan. That's all the questions that have come in for the moment. I might just give attendees a few moments just to get any final questions in that they might have. Let's just give it a sec, and then we'll wrap things up if nothing comes through. I think we'll wrap things up there, gents. On behalf of Centrepoint Alliance, I'd really like to thank everyone for tuning in. If we didn't get to your question today, please reach out and management will be happy to discuss further offline. We'll also look to make the video recording of this session available online. Really looking forward to the opportunity to talk to all of you again. And John, I might pass across to you now for any closing comments.
Yeah, look, I just thank you. I know it's a busy time of the year, as I said at the outset. Hopefully what Brendan and I are taking you through shows a business that's in a strong position and well placed. A lot of hard work over the last 14 months. We've got some exciting plans coming forward, and we look forward to being able to provide an update in future sessions and show you where we're taking the business. So thanks very much for dialing in. Appreciate it.
Excellent. Thanks, John. Thanks, Brendan. Thanks, everyone, for attending.
Thanks, everyone, for joining. Thank you.
Bye.